Shane Bangle with the Manna Group, back today to discuss more of the home buying process. Today we're going to talk about the financing contingency in the majority of offers. If you're offering cash to purchase a house, you don't use the financing contingency. There's other forms, evidence of funds, stuff like that you can do to strengthen your offer. But for most people, by purchasing a house, they are seeking financing from a lending institution. That, when you make your offer, you get to put a contingency that you're going to be able to receive a loan to purchase this property. Because when you go out and get your pre-approval, most lending institutions have looked at your assets, your income, and your credit score and done some verification to make sure they believe you could qualify to purchase a home, but they're not 100% sure. And that's why we have a financing contingency. So in there, you tell the seller, as the buyer, you say, I'm gonna get this type of loan, whether that's conventional, FHA, VA, chattel, USDA, a lot of other different types of loan. I'm gonna get this type of loan and I'm gonna put so much money down. So if you're getting a conventional loan, maybe 3%, FHA, 3.5%, VA, 0%, or maybe you're gonna try to show strength and you're saying, I'm gonna get a conventional loan and I'm gonna put 20% down, stating you are a strong financial buyer and that the financing contingency should not be of concern to the seller. So you state that in the beginning, and then you have the home buying escrow process to get your financing in order. So you're gonna work directly with the lending institution, submit your W-2s, pay stubs, bank statements, all kinds of things that they're gonna ask for to verify that your income and your assets are what they originally asked about. Those all have to be packaged together and submitted to what's called underwriting, and that's a third-party person that looks at it and says, okay, this person makes this much, they have this debt to income ratio, this meets our thresholds, and this loan would not be a risky loan. The bank will also send part of the financing contingency, has the appraisal wrapped into it, which I discussed in a previous video. Feel free to check that out. So the bank's gonna do all of those processes. So the risk to the seller is that as their house is off the market, the bank could deny you a loan. In that scenario, you would notify the seller, hey, I was unable to obtain financing, I need to terminate the contract and get my earnest money back. That's the risk and concern that the seller takes. Buyers obviously operating in good faith and having a good lender, a good lending institution behind you that says, no, listen, I have looked at their financing, they are well qualified, we are going to be able to get this loan done, is very important and shows strength as a buyer. Some important contingencies that exist inside the contractual portion is that you have 5 days from accepted offer to make official loan application. So typically when you get a pre-approval letter, the bank hasn't started the application process. That means collecting all the additional info, getting ready to go to underwriting. So you want to make sure that immediately once accepted, you notify your lender so they can start the application process. So you're saying within 5 days, I'll do that. Also, there's another contingency in the Washington contract that the seller can deliver what's called notice to perform. And this contingency exists. Typically, the standard timeline is 21 days. And at the 21-day mark, the contract has two options. Either your financing contingency automatically waives, or the seller has to deliver notice asking you to waive your contingency. The idea behind this clause is that there would be 21 days is enough time for the bank to get your loan, all your information together, take you through underwriting, and make sure you are clear to close to get a loan. If at 21-day mark, seller delivers notice to perform, you would have a choice as a buyer to waive the remaining of your financing contingency, get it over with, except for the appraisal, or you'd say, no, I don't feel comfortable, I'm not going to waive my financing contingency, and in that case, the seller would have the option to terminate the contract, and the buyer would still get their earnest money back. This is a clause that's not used very often, but it exists in the Washington contract as a provision for the seller. And also just maybe motivation for the buyer to make sure they're doing their due diligence on their loan. The financing contingency does protect the buyer that, if they get to day 28, day 29 in the escrow process, and for some terrible reason they or lose their job or lose income, they could terminate the contract and get their earnest money back, because if they don't have have a job, they're not going to get a loan. Financing contingency is a very important part of the purchasing process, both for the buyer and the seller, and this is why that clause exists.